Please advise your thoughts on opening vertical calls on UVXY with rather far date of expiration, 6 to 12 months after a spike, with even higher strikes out of the money calls. It has limited upside risk in case of Volmageddon and almost guaranteed chance of not being assigned. I'll circle back to that in a second. In my opinion, isn't it rather safe a good way of shorting vol? There's basically three problems that you're going to experience with this. The first one, I can just tell you, this is not a good way to short volatility. The best strategies you can come up with are going to be ones that take small amount of risk with very high occurrence. So a large number of trades. What you're talking about here is actually the exact opposite of that. You're talking about one big trade that's very long dated. This is always going to be worse. 40 small trades that are safe and protected is always going to be better than one giant trade that could go against you and ruin your entire year in one trade. So that's the first problem, but it actually gets significantly worse from there. So you said about 6 to 12 months. Let's just do 12 months just to keep it easy. So 336 days to expiration. This is the UVXY. And you said you're going to be selling a vertical call spread. So it would look something like this, right? This is the price right now. This is the break even. And here's the maximum loss right here. Okay. So this contract is paying 22 cents. Let's say you have a portfolio of $100,000. And this includes all your money. Your tradable income is $100,000. And you're going to dedicate $20,000 to your short volatility strategy. That seems to be quite reasonable. For us, for example, that does align with what we do. Basically, we do right now, we have 5 strategies with 20% each. This one right here is a short UVXY strategy. So yes, it has 20% allocation, but this is a high frequency, very well protected strategy. So all I really have to do is just ramp it up and take more trades. And that's how we make our profit. We don't want one big trade ever, like I said. But in this case, you're going to dedicate $20,000 of your money to this trade right here. Okay. So it's trading for a premium of 22 cents right now. Essentially, to get the number of contracts, you just take $20,000 divided by the maximum loss. So you're looking at, let me get my calculator, 20,000 divided by 78 cents. You're looking at 256 contracts. And you are going to be risking your $20,000 for one giant trade. So hopefully one thing is going to stand out to you right away. You are risking $20,000 to, at best, make $5,600. So at best, you're going to make about a 25% return if this goes perfectly well for you. Now, hopefully you're starting to see some red flags go off here that this is a terrible risk reward ratio. You should never risk $20,000 and an entire year of potential profit on one trade that, if it works out perfectly, can still only make you less than 1/3 of what you're risking. Like I said, what you actually want to do is a high frequency, very well protected strategy where you might get 40 trades that make 0.5% each. That's going to add up to a much better rate of return, and no single trade is going to put you at risk. So this is a terrible idea. The third problem, and probably the biggest problem, with these types of strategies, people typically do just look at a long-term chart and they try to calculate whether they would have been okay during, the biggest crash that they can find. So they look back and they see this big COVID crash, right? Where the UVXY went from 100 all the way to 1350. So it went up about 1,300% in a very short period of time. But you can see that it actually took 10 months to get back to the same point. Now, I do want to point out, please don't forget that the Fed and the government spent trillions of dollars to make sure that that happened. It was unprecedented easing of the economy and helicopter money and all kinds of crazy things to make this happen. But you can see that if you would have sold it here, yes, you would have probably been okay. But again, people typically look at charts and they don't realize how bad things can actually get. So if you really want to see what can happen long term, this is the SPVIX STR index. This is the underlying index that all these volatility ETPs are based on, not the new UVIX and SVIX. Those are based on short vol and long vol, but all of the standard VXX, UVXY, they're all based on this. You can see here, February 2007 reached a low and the bull market ended. Everything started to get a little ugly. UVXY starts to climb, and it didn't get back until the same point until 2010. So you're talking about a 3-year period where it was underwater in a major drawdown. And if you wanted to see UVXY specifically, that's the yellow line here. Again, this is February 2007, and it didn't get back to that point until 2010. We're talking about a full 3 years to get back to the same point. And they also rescued the market back in the financial crisis. Don't forget that. They had the TARP, they had the auto industry bailout. They had lots of reasons that could have been worse for a lot longer. And don't think that just because it was cured last time that it will be next time. So what I'm essentially telling you is, if you look at this chart from right here up until now, that is a roughly 16-year period. 4 of those years out of 16 years, you would have lost money on this trade. 25% of the time, you're going to lose your money. This is a terrible strategy. I know it looks here like it would have worked out and it's fine, but 4 years out of the past 16, you would have been underwater and you would have lost your full account on just one single trade. This is a terrible idea. And another thing that should give you a very big red flag is this trade is paying 22 cents. This is something that people often don't understand, but when you're talking about option markets, they are largely efficient. I know that there are people in the UVXY option market that don't know what they're doing. They don't know what the product is. And you think, it's taking candy from a baby because you understand so well. But what you have to understand is the larger volume. If you get rid of the retail people who don't know what they're doing, the vast majority of it, they are sophisticated investors. Everybody knows about the VIX futures decay. Everybody knows about contango. They know about roll yield. So if you're talking about a trade on a $1 strike gap that pays 22 cents, that in itself is telling you that there is a 22% chance this trade will fail. The reason that I highlighted your question and I emphasized this part that you said, it's almost guaranteed chance of not being assigned. I'm not picking on you here, but that's not even close to true, is it? I've already shown you that 4 out of the last 16 years, you would have lost your entire investment. And the contract itself is still paying 22 cents. If this was virtually guaranteed, this would say 1 cent. It would say 2 cents. The efficient option market that is a two-sided market would be pricing in a virtual guarantee. It would be a 2-cent contract. It's not a 2-cent contract. There's actually significant premium there to sell, which means there is risk there. That's exactly what that number means. And then the last thing I will highlight, and this is sometimes hard for people to visualize because what our brains naturally do when we backtest things is you will look, okay, if I short it here, I would have had 10 months and I would be fine. My question is, what if you get the timing wrong? What if you short it back here? What I mean by that is, just imagine the UVXY right now is at $5. Your short strike is at 6. So a year from now, you need it to be 6 or less. Let's say in the next 8 months, the UVXY decays at a normal rate. It just does what it normally does. 8-9 months from now, the UVXY is at $3. Everything's going well. You've made half your money. You've only got 4 months left. And that's when the spike happens. Not on the day I've got a year from the spike starting. I'm talking about in September, the UVXY looks great. It's at $3. Then it goes to 30. Well, now you don't have a year, do you? Because your contract was opened 9 months before that. You thought everything was fine. And then you woke up the next day and things started to get really, really bad. And now it has to go from 30 to under 6, not in 1 year, but in 4 months. What's the chance of that? So again, timing matters a lot with these types of trades. You're putting your entire year on the fact that one single trade is going to give you essentially a 20 to 25% rate of return, which it's good. I always talk about that's pretty good for a short vol strategy to make 20% a year. That would be fantastic. But if it goes wrong, 4 out of 16 years it would have gone wrong, you're talking about something that's terrible. So what I would suggest you do, there are many ways that are more efficient to short volatility than this. Again, I'm not trying to pick on you. This is probably better than selling a naked short call. Obviously don't listen to anybody who talks about that kind of madness, but this isn't a whole lot better than that. This is pretty poor. So what you want to do is you want to structure your trades so that you have a very high frequency of very low risk trades. Then you can just ramp it up. You want a lot of singles, a lot of base hits. That's what you're looking for. Don't look for these grand slam type things that if it goes perfectly well, boom, I'll make 25% in one single trade. No. The goal for investing is always to get the most amount of your money possible to work with the least amount of risk. And then you just rinse, repeat that over time and you should be good. So if you did get some value from this short clip, then please subscribe to my main YouTube channel in the description and also pinned to the top comment. And definitely tune in to our live streams and ask me any questions that you have. I'm always here to help.